Welcome to today's Explainer. We're breaking down one of Europe's most closely watched and, frankly, most fascinating utility stocks today, Iberdrola. Right now, there's this massive tension surrounding this Spanish energy giant. On the one hand, you have a company posting incredible growth and making some fiercely aggressive global moves. But on the other hand, the broader stock market just seems hesitant. It's a classic paradox, and we're going to unpack exactly what's going on behind the scenes and what the data is really telling us.
Okay, let's dive right into this. We'll be looking at the market context, their global investments, an earnings breakdown, analyst consensus, and finally, we'll wrap up with our final take.
First up, market context.
So if you've been tracking the Madrid Stock Exchange, you already know that Iberdrola, trading under the ticker IBE, has been on an absolute tear lately. But that actually brings us to the central paradox of our explainer today. With record profits on the books and literal billions being poured into multiple continents, why isn't the market aggressively buying up this stock? We really have to ask, is it possible that all the good news is already priced in?
To get why folks are hesitating, just look at this number. Yesterday, August 25th, shares closed at €20.13. Sure, it was up 0.5% on the day, but more importantly, it's hovering dangerously close to its 52-week high of €22.08. When a stock is bumping its head right near its absolute ceiling, investors naturally start asking, is there any room left to grow?
Moving on to global investments.
To figure out if there's gas left in the tank, we have to look at what they're actually doing on the ground. Yesterday, over in Bilbao, management laid out an incredibly bullish operational story, and this brilliantly illustrates their aggressive, three-continent capital deployment blitz. Let's walk through it. Step 1 is the UK. Under their new regulatory framework, they're rolling out a jaw-dropping €15 billion expansion. Plus, they're integrating ENW, the Northwest England distributor they just bought for $5 billion. Step 2 is the US. Their €4 billion offshore wind project in Massachusetts is now fully active, generating real revenue right alongside massive transmission rollouts. And finally, Step 3 is Finland, where they're pushing a €5 billion acquisition of Caruna through the regulators, which should close in early 2027.
So management is clearly seeing major traction across these markets. In fact, they dropped a pretty huge hint in Bilbao, casually mentioning we could expect, quote, good news after the summer. For anyone reading between the lines, that's widely being taken as a potential upgrade to their full-year guidance. It really cements what is already a remarkably strong operational story.
All right, part 3, earnings breakdown.
The strategy sounds incredible, but do the financials actually back it up? Let's peel the onion on their first-half earnings from July 22nd to separate the flashy headline numbers from the true operational engine. On the surface, reported net profit looks absolutely massive at €4.36 billion. But hold on, that includes a one-off €953 million gain from selling fossil fuel assets in Mexico. If we strip that noise away, the adjusted net profit sits at $3.57 billion. But here is the crucial takeaway. When you exclude the drag of currency fluctuations, like a weak dollar and pound, that adjusted profit actually surged by a very impressive 14%. And that 14%, that's the real core operational growth the market cares about.
Now, what's really interesting about this is exactly where that growth is coming from. If we look at their adjusted EBITDA of €8.05 billion, more than half of it, $4.21 billion to be exact, is being driven straight by their networks division. We're talking regulated electricity transmission, distribution, and smart grids. That specific slice grew 13% all on its own.
And they are leaning hard into that success. In the first half of the year, capital investment hit €7.01 billion, which is up 25% from last year. And look at where that cash is flowing. Over 63% is pouring directly into regulated network assets. This is a totally intentional pivot. By stacking up regulated assets, they lower their overall risk and create incredibly stable, predictable cash flows. In fact, their total regulated asset base has ballooned to roughly €55 billion.
That lower risk and highly visible cash flow gives the board a ton of confidence, and they're passing that right along to the shareholders. The confirmed 2026 dividend is €0.685 per share. That's a 12% bump, pushing their total expected shareholder payout to an unbelievable €4.5 billion this year alone.
Which brings us to Section 4, Analyst Consensus.
So operationally, Iberdrola is firing on absolutely all cylinders, which brings us straight back to our central mystery. Why isn't the market overwhelmingly buying? Well, an S&P Global poll of 23 analysts recently yielded a consensus rating of just a hold, and the average 12-month price target is €20.51. When you realize the stock is already sitting at €20.13, that target implies less than a 2% upside. The average analyst is basically saying, yeah, the stock is fairly valued right where it is.
But let's put some weight on the scale and impartially break down the fierce debate happening on Wall Street right now. On the bullish side, you've got Bankinter slapping a buy rating on it with a 2360 target, arguing the market is totally undervaluing their massive networks pipeline. Barclays agrees, calling them the gold standard of European utilities with a 2260 target. Then in the middle, firms like RBC and Bernstein are sitting on their hands at neutral or hold around €20. They acknowledge it's a stellar business, but they just don't see an immediate catalyst to push the price up. And on the cautious side, Deutsche Bank has a hold with a target of just 1850. Their rationale? They're sweating the valuation and the sheer execution risk of juggling these massive multi-continent projects.
And Deutsche Bank's valuation anxiety really boils down to this number, 26. That's Iberdrola's PE, or price-to-earnings ratio. Trading at 26 times earnings means they are sitting at a clear premium compared to the rest of the European utility sector. And when you're priced for perfection, there's absolutely zero room for error. It makes the market jittery over things like currency headwinds, or the risk of delays on billions of dollars in offshore wind rollouts. The consensus is essentially saying, it's a great company, but at this price, it's certainly no bargain.
Finally, Section 5, our final take.
All right, so we've got a company executing flawlessly on a massive global scale, but carrying a premium valuation that is analysts split down the middle. How do we sum this up? Honestly, your verdict here depends entirely on what kind of investor you are. If you're a long-term investor with a 3 to 5 year horizon, Iberdrola acts as a rock-solid quality compounder. You're getting a smart pivot towards stable networks, a rising 12% dividend, and a price that is highly defensible for an income-focused portfolio. But if you're a short-term momentum trader, the consensus suggests your upside is pretty limited right now. Your key catalyst to watch is the October 21st Q3 earnings release. If they follow through on that hint and actually upgrade their guidance, you might see a pop. Technically speaking, you'll want to watch 1950 as your floor and €22 as your major resistance ceiling.
So I'll leave you with this question to chew on after reviewing all the data in this explainer. Are you looking to jump in for a quick momentum trade, or are you hunting for a long-term high-quality compounder to anchor your portfolio during the energy transition? The numbers are crystal clear, their global strategy is aggressive, but with that PE of 26, the choice ultimately comes down to your personal investment horizon. Take a hard look at your own strategy, run the numbers, and see where this utility powerhouse fits for you.